Okay, folks, I'm sorry I'm a little bit late here, but welcome to Sunday Night Futures Live. If you haven't already done so, please head on over to the forum, which is free, and enter your symbols that you'd like me to review into the here. I'll show you for visuals. And if you are new and you don't have a free account, literally free, head on over and just open one up, no credit card required, and enter your symbols in here in this chat area. I just posted this. We only have a couple so far, so we have plenty of room to go. So today's topic is really going to be about, are we in a bubble? And is it the time to begin bear operations on the equity markets? Or if you're already short, is it time to begin building or adding to a short position? I spent a lot of time on analyzing past bubbles relative to this bubble and some strange outcomes. Some correlations, some not so correlated. And we'll talk about those as much as I can because I went down a rabbit hole and I have so much data. I can only give bite-sized pieces out. I'm probably going to do a much larger, just a video on it where I can edit out all my nonsense rather than trying to filter out all that I want to say that I went through on Grok and on ChatGPT, trying to validate all of the information I was getting from one AI bot to the other one because I want accuracy. So we'll talk about that a little bit tonight. We'll talk about MAG 7, how they're holding up. We'll talk about the QQEW. That is the equal weighted triple Qs. That means all stocks in the triple Qs have an equal weighting 1-for-1, not NVIDIA and Microsoft and Apple being the top three kahunas in that basket, driving the whole triple Q bucket up higher. So let's get to the futures action and see what's going on here. And for the first time in a couple of weeks, I had expected to see us turn green here. We have not yet. This is a 5-minute chart of the E-minis. Let's let this settle down. And we'll go to some comments. George, welcome. Lee Cable, welcome. Larry, I saw that. I was very, very pleased to see that body language. Really, really good stuff. I was very, very pleased. Yeah. I don't know if he kissed and made it's in his best interest. The Democrats hate him. He can't afford to have a Republican hating him too. So for Musk, it's a very, very wise move to do nice. And he's been very quiet. He's a businessman. He should stay quiet. Apparently, the Charlie Kirk ceremony today was oversubscribed. I think they had something like 300,000 people there. Amazing, great stuff. Really good to see such a large gathering of positive mental attitude. So in looking at the opening price action here of the E-minis, we're seeing some weakness. Not a lot. We could call it flat if you want. That's fine with me. Let's go to the NQ, NASDAQ 100. NQ down 0.10%. Very similar price actions to what you saw on the E-minis. They tried to rally them off the lows. Rejection. Small caps, no shock here. Small caps are poised for potentially Multi-year higher highs. I think they may have hit them last week. But right now, small caps just barely holding on to positive territory. Let's go to the mid caps. Mid caps a little bit sloppy as well. Let's check in with the greenback US dollar. US dollar continues to show strength. There was a beautiful bullish reversal bar on the week last week on the dollar. Here. Held support. I think we can go higher. Let's check out euro yen. That's not euro yen. Euro up first. Euro down. Euro on the week opening up below a support level. We closed up last week, but we faded off the highs of the week. We're opening up below a support level here in red. Let's make that dash line a little bit thicker. And there you have it. Yen. Yen had a bearish reversal bar last week. We're opening up or flat at current. This to me looks like a bull flag setup potentially, and that we could possibly break out. But you're going to need the euro to rally with the yen for the dollar to pull back. So the euro is the pimp Mac Daddy of all the other major currencies out there to battle against the dollar to drive it lower, unless, of course, you get a combination of Canadian dollar, Aussie dollar, Japanese yen all rising up higher, Swiss franc. Let's go back. Let's check in with energy. So oil getting a lift at the open here. Oil on a weekly time frame is trading at the lower band of a triangle formation at very, very precarious levels. It really needs to rally. So oil opening up 0.16%. As for natural gas opening up just shy of a percentage point. We added more to our natty gas position, Boyle, last week. Let's see if we make higher highs here. Okay. Gold. Gold gapping up here. Even with the stronger US dollar last week, gold didn't care. The miners didn't care. We seem to have stalled out here. Didn't want to do that. Let's try that again. Above. Okay, let's do below. Below. Okay. Silver. Wow. Nice little move here. Up 1.15%. Not as extended as gold is. Clearly more upside here for silver. Let's check in with the other precious metals. Palladium. We have a position here. We'll go to platinum in a second. I don't have a position on platinum. So we're opening up over a half percentage point. Let's check out the weekly close. We're holding this 15-period moving average in white. Let's go to platinum. Platinum up 0.22%. Gold broke out to new session highs just now. Can gold go parabolic? Let's check in with wheat. Let's go to the weekly chart here. Bearish reversal week last week. Corn. That reversed last week as well. And soybeans. Not a good time of the year for agriculture right now. But they are building bases, no breakouts here. The way I would look at these charts is that you want to appreciate the fact that we stopped going down back here, at least in the case of soybeans. And this applies to anything. It could apply to stocks, commodities, bonds, the price of cupcakes. Who cares? Doesn't matter. What you want to see is a bottom. You want to see a higher low. You want to see consolidation. That's exactly what you have here in the commodity space. Once this breaks out, you're going to get a massive rally here in the commodity space. So could be this week. It could be next month. Who knows? But the longer the consolidation, the greater the validation of any breakout. Let's say hello to folks who are just joining in. Mr. Sean, welcome. Polish Taco. It's been a while. How you doing, pal? Talon. Hey, brother. Welcome. All right. What didn't I go over? Let's take a look at bonds. Let's go to the yield. The yield is always more interesting to me. And thus far on the week, gold, new session higher highs, new all-time highs. Yields are down at the open here. As for volatility, volatility is flat. Let's bring up gold again, see what it's doing. I misspoke. Gold did not make new all-time highs. I was back here. My apologies. Last Wednesday. But it looks as though we're going to take out highs. Very bullish stuff. So that's the futures action. So, all right. I spent a lot of time this weekend. Did I go over crude? I did go over crude. I spent a lot of time looking at. Oh, I didn't go over crypto. Excuse me. I spent a lot of time taking a look at the prior market bubbles and where we stand at current. XRP opening well, opening down here 0.62%, back down below $3 a share. Bitcoin barely positive, looks pretty weak here. The big picture is the weekly chart of Bitcoin. It still looks pretty good, as does XRP. Okay, so let's first go over economic data that's coming out this week. So we have a bunch of Fed heads coming out tomorrow. I don't expect much there. Tuesday, S&P U.S. Services PMI. More Fed heads. Powell's going to be out speaking. Wednesday, new home sales. Watch out for that one. Home sales have been really wonky of late. Thursday, more Fed heads out. Initial jobless claims. We saw a pullback on initial jobless claims. That was like the first week in many where we saw a pullback on initial jobless claims. It's a good thing. Now, GDP third estimate, I don't expect much here. Durable goods, very important number. They're expecting a decline of 0.5%. That follows a decline the prior month of 0.28%. So we have negative reads on durable goods. For those not familiar with durable goods, those are large dollar equipment, large high ticket items that last, say, 5-10 years, washing machines, dryers, refrigerators, etc. Very difficult for this metric to be positive in a weak housing environment. What do you do the first thing you buy a house? Paint, new appliances, whatnot. So that's not happening right now. Friday, personal income. And I think this is going to be the most important number of the week. This is the Federal Reserve's favorite measure of inflation, the PCE. Now, as it stands right now, the market has priced in, as far as the eye could see, Fed rate cuts. October, probability of an ease 92. December, probability of an ease 99. January, probability of an ease 99.5. So on. You don't want to go past January, but you get the drift. The probability of an ease is out there. So Fed Chair Powell was asked, hey, listen, what's a quarter point cut going to do for the economy in real terms? And Powell's honest answer was not much. So it's going to take a number of these rate cuts for the markets to absorb, work their way through the system. It takes 6 to 8 months for the first rate cut to work its way through the system. Now, if you get a hot PCE number, meaning this number here comes out hot, inflation moving up higher than expected, well, what do you think happens to these probabilities moving forward? They come into question. And when you have a market that is valued the way that this market is valued at, you have no room for questions. Earnings need to be perfect. Fed expectations need to get hit. And if there's a probability of the Federal Reserve not cutting rates, which I don't expect, then you're going to see the market come under all sorts of pressure. Now, in terms of valuations, we're at the doorstep of breaking through 40 on the Shiller PE ratio. We haven't been above 40 since 2000. And when we broke below 40, that's when the floodgates of hell opened up in the stock market. I have those charts at the ready. I'm going to be showing them in a moment. But that's when things got real fast in the equity markets, is that when we broke below 40, we were above. For context, for those looking at this chart here and saying, I want to go shorting the market aggressively because Bob just said, hey, listen, we're going to be trading it above a 40 handle on the Schiller PE ratio, second highest since 2000. We must go down. We must go down. For context, we traded above 40 on the Schiller PE ratio for roughly 400 days. Think about it. So you can't use the valuation at current as your sole barometer for putting on a big short position on this market. You can't do it because we know that from our research that we could stay above this mark. Markets could stay irrational longer than you could stay liquid. In terms of the Buffett indicator, we are at strongly overvalued levels. Never before in the history of mankind has the equity market been this overbought. I think that we may even be higher than 2021 now. That's when we went into that bear market of 2022. Yeah, we are. Well, at least the stock market value is higher than 2021. But so is GDP. It looks as though we're higher than 2021. And we are, I mean, we're far greater than a 2 standard deviation move above. You know, frankly, it's unsustainable. But, you know, I wouldn't advocate putting on a very large short position just yet because the charts are not screaming extreme overbought yet. They're just not. In 2021, they were. In 2000, they were overbought. In 2000, they were extremely overbought. In 2020, they were overbought. And in fact, in 2021, I'll go over the chart in a moment. I said I was doing an interview with TrendSpider, and I said the market was in a big bull run. I said I don't think this is going to last. And sure enough, it lasted for about another couple of months, and then it was crash. Okay, so you're going to see a lot on Twitter about the reasons why we need to be short of the market. U.S. margin debt at all-time record highs. As for the driver of this market, I didn't have a lot of time to get prepared tonight, so pardon me for not having this stuff at the ready. Here. So keep that in mind. You have U.S. margin debt at all-time record highs. And in blue is the average. Here, retail investors have bought nearly $4 billion in U.S. equities on average per day so far in September. This is 4 times above the 2020 to 2024 average. That includes that bull market run. This is the second straight month where buying exceeded the average by this much. Tell me that we're not late stage cycle without saying we're at late stage market cycle tops, because you have the retail investor, which is just plunging capital into the market. But that's what's keeping this market up. It's the passive inflows of retail buyers. And not to mention, let's face it, you have deposits into 401k plans, etc. This can continue. Now, when we look at, this is the 1987 crash. No, it's not. Where's my 1987 stock market crash? Here. 1987 stock market crash, double top, confirmation breakdown. Typical. Nobody knew it was going to turn out to be like this, but typical double top, confirmation breakdown. This was the 2000 top. Again, double top, confirmation breakdown. Classic textbook double top confirmation breakdown. This was 2020. This is when I made the call right here that I didn't think this is sustainable. This is when COVID was first coming out. I looked at it and I read the book many, many times, reminiscences of the stock operator and how he went short the market because he knew that the San Francisco earthquake was going to rock the markets. And it was early to that trade, but ultimately he was proven right. And the stock market declined rapidly. And this is exactly what was on my mind back then. Everybody was ignoring the fact that COVID was just being unleashed on the globe, and the markets kept moving up higher until they couldn't deny it anymore, and the markets went into free fall. NASDAQ composite. This is when? This was 2022. Again, classic double top, confirmation breakdown. So there's nothing here that is unusual, except for the fact that the veracity, the length of the sell-off was, very dramatic. It was bubble-like behavior. And here we are at current. Technically, do we look like we did at the tops of the prior bubbles? In fact, let's take away 2020 because that was a binary event. There was no double top there. It was just, it was like the Wile E. Coyote moment. Oh my God, COVID's here, drop. So there was no time for a double top. But we are not seeing that just yet. Now, might we see it between now and next couple of weeks? Sure. We don't know. But there's no technical reason why this can't proceed up higher. So I'm actually encouraging people, don't get aggressively short right now. And in fact, whatever short I have on the table right now, I'm thinking about lightening up on it if we put in new weekly higher highs. Or if we get a sharp pullback. The average pullback during the bubbles that I just went over with you was about between 8 and 10% on average. So if we got an 8 to 10% pullback here, that's an average pullback for all the other bubbles that we've seen in the past. And I'll be honest with you, I think it was ChatGPT I was doing some analysis on. They spit out some data, and it said 2025 was as if the bubble had already happened. And I said, wait a minute, are you telling me the 2025 crash has already happened? And it said, yes, deeming this to have already been the crash of 2025. So while we have valuations which are at ridiculously overbought levels, folks, technically, with the passive inflows into the market, it can continue up higher. And the modeling I did with Grok and ChatGPT implies that on a technical basis, not on a valuation basis, but on a technical basis, for us to get extremely overbought, there's a potential for an additional 20 to 25% upside in the equity markets or the NASDAQ composite. That's what I was using as my barometer. So let's be careful here. Don't get aggressively short the market just yet. We don't have the signal. Once we, just going back to any one of these, once we get this signal here, rally, pause. We put our line showing that support level, rally, failure to break out to new higher highs, or an overshot double top, meaning we do take out the prior high, yet we can't hold it, and then we break down below that prior low. That's when you short aggressively. That's when you get nuts. Right now, we are just not there yet. And I'll go to a chart of the triple Qs in a moment, which shows you a short-term time frame where I think that we're probably going to move up higher too, even though at current, let's check back in with the NASDAQ. It's down fractionally, not much. This could easily open green tomorrow. So what I want to know is here, do we put in new weekly higher highs? Because that's going to tell me the path of least resistance remains to the upside. and you don't want to fight the tape. So the strategy that I'll be taking here is that I want to know if we put in new highs on the week. Okay, so the strategy that we'll employ is similar to the Buffett method, except with a twist. Uh, let's say we raise 50% cash, keep our 50% of our short position on right now, take 50% of that current position, put it into cash. Now, if we're expecting a parabolic blow off top in the market, let's be conservative, 10 to 15, 20% higher. The modeling that I did said 20 to 25%, that we could still move up higher before we went crazy overbought levels. We would take a percentage of that cash we raise and put it into the TQQQ, which is the long triple Q. So we hedge the remainder of our short position and we keep cash on the sidelines. That's the short-term plan, because the one thing that we cannot ignore is this. We can't ignore this. So to say that I'm going to go from having a short position to a net long position, there's no way I'm going to do that. Not with margin debt the way it is. And for those that are wondering, what difference does this margin debt make? You need to remember that when times are good, money's cheap, liquidity is cheap. The brokerages are going to let you borrow as much as you can against your positions. They're fine with you doing that. But once volatility begins to break out, you may go to sleep and say, you know what, I still have $20,000, $30,000 worth of buying power. I'm good. But the one thing they don't tell you or they don't advertise is that when you go to sleep and their algorithms pick up that the market volatility is implying that we're going to get higher highs on volatility, guess what they do? They raise margin requirements. So even if the stock market opens up flat the next day and you had $20,000, $30,000 worth of buying power, they could drop that down by 20%. And all of a sudden, if you get a sharp pullback in the market, all of your buying power is gone and you're looking at a margin call. So your broker is your senior partner. The minute you take out that loan from your broker, you become the junior partner. They're the senior partner. They tell you what you're going to do and when with your portfolio. So be careful. All of these people here, retail in orange, that are buying 4 times as much as they normally would in equities on margin. Well, this doesn't end well. It never, ever does. There's no soft landing here. It doesn't happen that way, unless, of course, you're using a trailing stop loss order on your position. Now, I want to do a number of stocks, the Mag 7 names. I want to try to get through all of them. But before I do that, I want to give a warning to people. All over Twitter, I am seeing these charts about how we can't move up higher according to historical trend lines. The trend lines are very, very good. I live by them. The thing to remember is that trend lines are meant to be broken. Eventually, they will be broken. So if you see this being presented to you on Twitter or whatever your social media of choice is, that we're nearing the all-time highs and that we must pull back, we must correct, not necessarily. And I have an example. Take a look at this chart here. This is a chart that goes back to 1977, the beginning of the NASDAQ composite. Now, prior to, here, let's update this. Prior to the 1987 stock market bubble, we had resistance levels. Here, look at this. Look at that. But what do? Right here in 1995. We blew through it. I want to get the percentage move here. Let's go from 1995 here. That was a 445% move up higher in the NASDAQ composite. Fast forward, after the dot-com bubble, we broke out yet again. You play connect the dots. Here, this should have been back here in 2020. This should have been the resistance level, and we did fall. We dropped down to the 50-period moving average on a weekly, monthly time frame. What do? We rallied back, ripped through it like a hot knife through butter, rallying up and into the 2021 highs when we went into a bear market. So while sure, these charts look exciting, you need to put things into context and realize that historical trend lines have existed forever. They have been broken through, and new historical resistance levels have formed. So let's take a look at where we're at current on the triple Qs. First, let's say hello to folks that just joined in. Traveling back from Ecuador. Did you go to the Galapagos? TZ Burton, welcome. And I just got a message that on some channels, whether it be Facebook or X, messages aren't able to get communicated. I'm not ignoring you. For whatever reason, the software is having a problem transmitting your messages. We are getting them through YouTube, but all I see is YouTube right now. There's one X here. So X may be working. All right, so let's take a look at the equal-weighted triple Qs. This is TrendSpider. Folks, automated technical analysis. If you are new to technical analysis and you want to validate your trend lines are accurate, how about having this at your disposal? Automated trend lines. Click of a button. Just click of a button, and there you have it. And you could see that the QQEW hit weekly resistance last week. I didn't know that before I went live because it was looking so good on Friday. And now that I see this, I'm saying, okay, I need to change my tune here a little bit about the equal weighted potentially outperforming the triple Qs because the triple Qs look a little bit more bullish. Anyway, TrendSpider, you could see all the tools here, all the resistance levels, all the support levels, link below, 35% discount. Use discount code CON35. And on Twitter and Facebook, link above, discount code CON35. They have Sidekick, which is now AI built in here. I played with it a couple of times, not a lot, but it seems like a lot of fun. So go crazy, have a blast, and plot out your week. So you can see here the QQEW, the equal-weighted triple Qs, bull flag setup, and a breakout. Bullish. What about the QQQ? Is there more upside to be had? Yeah, because what did we do last week? We closed above resistance. Might we get a retracement back down to 598? Easily. We hit 600 on Friday. We backed off of it. They couldn't close it above it. Can we get down to 598? No doubt about it. If we hold this week, I think that we rally up to between 616 to as high as 625 per share on the triple Qs. Now, if we fail to hold this resistance level, again, automated trend lines, if we fail to hold this, I think we could retrace down to around 580 on the triple Qs. Let's take a look at seasonality and how this week looks We know the month of September is a fairly weak one, but that's not the case this month so far. We're now beyond the halfway point, and it looks pretty bullish so far. So you can't always rely upon seasonality. But when you take a look at a weekly view here, we're up about 53% of the times on Qs. So it's a coin flip. Last week was one of the worst weeks out of the month, and we closed up. Maybe we pulled some demand forward. Who knows? Now, I want to go through some of the Mag 7 names. I want to begin with Apple. Let's see if there's more upside here. And there is. Apple, we're going to $2.59 per share. If we pull back, I think we go to $2.40 per share, and then we move up higher. So Apple looking good here. Good volume last week. Path of least resistance remains up. Amazon at resistance. According to this volume shelf, a little bit of resistance at around 230. Let's call it 234 per share. If we close above 242, I think we go up here to around 262 per share on Amazon. Google hit some real serious resistance last week, and we closed above it. So I suspect, let's go to a daily chart here of Google. We broke out on the 15th, failed to hold on the 16th, recaptured on the 18th, held on the 19th. So this is a little bit porous here, but it's got underlying demand here. So the path of least resistance remains higher. You have a Fibonacci retracement level or Fibonacci resistance level at around 259.50 per share on the Google. Back to the weekly charts. Meta. Let's clean this up a little bit. Meta is in a ascending wedge formation. Their revenues have slowed quite a bit. This is a quarterly view. Back to the weekly view. I don't like this chart. I thought I would like this chart, and I don't. I think we could have a potential double top on Meta. But that's only a double top if it closes down below the lows of the week of September the 1st. If it doesn't do that, and if it fails to, and it just trades sideways, it's a consolidation. You don't go shorting it because it's a consolidation. So I would be very careful here with shorting Meta and buying Meta. Is it a hold? Sure. Microsoft. Microsoft, nice rebound these past couple of weeks. Revenue growth continues to slow. Let's go to the quarterly chart here. I mean, really, revenue growth is stalled out on Microsoft, yet it's sporting a pretty rich PE, price to book, price to sales. I'm telling you, normally I'm a technician by heart. And normally the technicals align with the overvaluation of the market. And that's my wheelhouse. I feel better with the technicals than I do with the valuation. But this time around, it's kind of different. And I hate saying it's different this time, but it's different this time. So I'm a little bit out of my element. I don't know how you ignore the slowing of revenue growth and the fact that these stocks continue to grind it out higher. They're still growing. They're just not growing by the leaps and bounds that they were, yet they're sporting multiples that are out of this world. NVIDIA. Now, NVIDIA is a different kind of animal. Now, what I'm concerned about with NVIDIA, even revenues here have slowed down. What I'm concerned about with NVIDIA is that last week, and I did some research on this over the weekend. Last week, you had the Chinese that came out, and they demanded that Alibaba and all their big companies over there come up with a chip or use chips that they've developed in lieu of NVIDIA's chips. You had a one-day sell-off on NVIDIA, and then all of a sudden the stock just rallied back. To me, it looks as though it was priced in, but I'm also of the opinion that there's a lot of apathy in the market right now. You're seeing it on the bullish percent index, on the S&P 500, on the NASDAQ, not so much on the S&P 500. Way too much bullishness. VIX is very, very weak. So lots of complacency. The put-call ratio fell apart last week. It looked as though we were going to have a huge week last week, and we did. Early on in the week, put buying just ripped through the ceiling, and then by the end of the week, it was at extreme oversold levels. So the fact that the markets are shrugging off, or as I like to call it, whistling past the graveyard of NVIDIA here, and that announcement out of China, I mean, I think there was a warning shot by the Chinese across NVIDIA's bow. And the markets didn't care, and they should. NVIDIA is the number one component of the triple Qs by market cap. Let's take a look at Tesla. Tesla had a huge month thus far. Let's go. I want to go back to their quarterlies. Revenue growth, I mean, where is it? Where is it? Yet they're going to grind it up higher. We are into the third standard deviation Bollinger Band on Tesla. Just before one, volume is really, really good. But some of these are pretty frothy, and on most of these, revenue growth has stalled out. And I view that revenue growth, because revenues equals sales, is far more important than earnings per share, because earnings per share could get manipulated. Sales are sales. It all depends upon how you book them. Wouldn't a recession clean things up? Reagan wanted rate cuts, but Volcker said no. It turned out pretty good. Yeah, it would. Yield should be higher. Yield should be higher. How do I put this? The data that the government is feeding us about jobs implies that we should have higher yields. But the housing market is now stalled out. They want rate cuts to help, A, decrease the payments that we make on interest every year, and to use that capital and maybe bring down the debt. I don't think so, because their deficit spending just doesn't end. It's just there's no end in sight. So I think a recession would be good to clean out the mess. Let the companies that should fail, get them out of the system. But I don't think the Federal Reserve is going to let it happen. I don't think that the federal government's going to let it happen. Especially as we're heading into the midterms now. No one's buying is U.S. soybeans, trying to cancel all of their orders. Okay? Didn't know that. Mexico rejected 5.7 deal for U.S. corn and did a deal with Canada. Didn't know that. Good stuff. Smart people on this thread, on this live stream. U.S. losing billions of dollars as tourists stay away from Trump. $20 billion in retail spending from international tours at risk. I'll be honest with you. I'd rather come to the United States than Europe right now. I've been to Europe a couple of times over the past couple of years. England, France, Ireland, Italy. They're not doing well over there at all, at all. So from my take, I'd rather be in the States right now. Las Vegas Strip slow. Well, the Las Vegas Strip slices its own throats. The prices over there are out of this world. If you want to put a soda into a refrigerator, the minute you open up that refrigerator door, they charge you like a crazy $50 charge for cooling of your beverages. I mean, it's nuts. You're not even buying anything out of the refrigerator. You're just using it. So, I mean, you can't nickel and dime people like that. Gilda, hello. It's always good to see a lady come on here. Unfortunately, I believe the stock price is not relative to its value. It is a number on its own. We see fundamentals that should affect prices, but nothing happens. Well, that all goes back to capital flows. What's driving the market up higher right now? What's the proximate cause of the rally? It's retail. Retail right now is driving the market. Sure, you have algorithms they're front running the retail money. They're seeing the orders come in through retail. What are the algorithms doing? They're getting ahead of that flow, and they just grind it out higher. So good point. I agree with you. Let's do some chart requests. So yeah, to your point, Gilda, they can keep this party going a while longer. We kind of already did Tesla. I'll go in more detail, John, for Tesla for you. Okay. We have George up, Sean, Talon, John, Pete. Let's do it. Again, folks, help support the channel. Get TrendSpider 35% off. Link below on YouTube. Link above on Twitter and Facebook. CON35. Get 35% off of all their plans. Let's do it. Big Bear AI. Do they not have revenues? There's no data for this symbol. I'm sure they have revenues. It's just not appearing here. Okay. You have a lot of overhead supply here on BBAI. I mean, really nice week last week, and it'll probably continue up higher. But I think that you're going to have resistance right up here at this fractal resistance level at around $8 a share. Now, if you close above, let's call it 810, 825, you're probably going to take out this resistance here, or at a bare minimum, challenge it at 859. If you clear that hurdle, you come up here to around 1035 per share, but you got to get through $809. 809 is your number. Daily chart. Now, if you're looking for an entry point now, no matter what I say, you're going to buy the stock no matter what, fine. You broke out above major fractal resistance on Friday. You're going to get a retracement in all probability. Not a definite, but a probability right down here at $6.80. Put your limit order in there. Scratch the itch. Don't get too nuts. Satisfy the demand, 20% of your intended allotment, and then wait for these obstacles to get overcome. 809, add more above that limit. Then above here, 859, add more there. BBAI looking good, but you want to build the position. Build the position. URA. I mean, this sector is just in fuego. I'm surprised Franklin's not on because he's like the Pimp Mac Daddy of these stuff. Oh my God. Oh my God. Amazing. It's going up. It's going up. Let's take a look at the monthly chart. Let's get my drawings off here. Let's get the fractals off as well. Too much noise. Okay. Let's go to the monthly chart. If you're looking for a retracement here, around 45 bucks a share on a retracement, you're leaning into monthly time frame, third standard deviation Bollinger Band. So just be careful. Weekly chart, we closed at the highs of the week. Very high probability we put in new weekly higher highs, even though the monthly chart's overbought. Very powerful chart. Huge bull market here. Daily view. The path of least resistance remains up. Volume was good. Not great on Friday, but very, very good. Bullish on uranium. Talon, SEDG. I haven't thought about that stock since the last time you bought it up, about 2 years ago. Right about there, about 2 years ago. The hell is this? Why is that doing that? Let's go to the weekly chart. Oh, this is the fundamentals. Hold on. Let me get this off. It's skewing everything. Their revenues really dropped like a rock. But it's cheap. This is the valuation, price to sales. It's fairly cheap. Let's go to the weekly chart again. Cleaner view. Let's get rid of this. Look at this Bollinger Band squeeze here. I think it goes up. Especially if oil prices recover and they begin to move up. These are highly correlated to crude oil. So I think that this is going up. I'm bullish on SEDG. You're probably going to get a retracement because we broke out last week. You want to scratch the itch at around 34 bucks a share. That looks pretty good. Daily chart. Yeah, look at this. We broke out on the 17th, retest, and then a follow through on Friday. SEDG looking good, bullish. Tesla. I want to try to clean this up a little bit. Okay. Let's go to the monthly chart. So I think this is the money shot here, to be honest with you. I drew this line here a long, long while ago, 440.31. We're close to it. I think that's major resistance. The however is if we close up above it, I think that we could head up to 600 bucks a share on Tesla. And I know I said earlier that their revenues do not look good. Doesn't matter. With Tesla, it's all about the hype of autonomous vehicles, robots, blah, 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 blah. So As much as I don't like the volatility of Tesla to be an investor in it, I think that the path of least resistance is to the upside. It's probably going to go up higher. We close above 440. We're going to go to 600 on Tesla. Good consolidation last week. There's 440 right there. That's going to be your launching pad. You get through there, you consolidate, watch for that rip up higher on Tesla. I don't like the fundamentals, but I'm bullish on the stock. LXU. I don't know this stock, so I want to pull back to see where it's been, to identify where it might be going. Quarterly chart looks really, really good here. You have a higher low. Weekly view. We broke out the week of August the 25th. A bunch of retests. I think that this is going to probably go up. Next resistance level is up here at 897 per share. Volume last week was strong. Daily view. Not a screaming buy. It's not, but the weekly chart looks good. It's a recovery play, more of an investment than a swing trade. So buy on strength. If we close above, let's go back to that weekly chart. Buying here is fine. A close above $9 a share would have me adding more to the trade. So LXU looking bullish, recovery play. I wouldn't get overly aggressive with this one. Folks, thanks for being here. I want everybody to have a profitable trading week, and everybody have a great night. Thank you for being here. Be well. Don't forget about TrendSpider, 35% off, discount code CON35. Take care.